Yeah, g'day everyone. It's Jason Haynes here from QPL Rural again, and today I've got the pleasure of talking to Tony Paton from Property Ally. How you going today, Tony?
Yeah, good, Jason. Good.
Yeah. So, Tony, tax time's coming up, and you have a new business. I suppose it's been around a little while, but you deal in property depreciation. Tell us a little bit about that, please, Tony.
Yep, sure. I guess news probably right in that a lot of people are still only just hearing about it. We've been operating, specialising in farm depreciation for about 8-9 years, I suppose. But we're still finding farmers and accountants that are not aware of the benefits or the savings that are available to them.
So a lot of people, I was going to say, a lot of people know about, like, people say, oh, we've got a depreciation schedule because they've got, one the accountant does up on their machinery. How's this different?
Yep. Okay, so it's same and it's different. So you understand the principle of someone buys a tractor, for example, then they'll depreciate that at the appropriate, or the accountant will depreciate that at the appropriate rate, and that'll go in machinery or plant depreciation. What's also available is anyone that's bought a property or anything to make an income out of, we can then depreciate that going forward as well. The difference is,
go on.
The difference is, I guess, is with the tractor you have, like you paid, say, $90,000 for that second-hand tractor or whatever. With what we do, we identify, let's say you bought a farm for $1 million, then we go in and separate all the assets on that farm away from the land value. So we put a starting value, if you like, on, for example, the sheds, the silos, the fences, yards, anything that's man-made on that property.
Righto. And then that forms part of a depreciation schedule then?
Yeah, so then, so it's not a replacement value, but in very simplified terms, it's a proportion of the purchase price, as I say. And then, the balance of it is the land value. So then what the quantity surveyors that we use will apply the appropriate tax rate to the different items. So, for example, sheds will depreciate at a different rate than fencing, fencing a different rate from silos, etc. So then a schedule is made up saying, all right, we've got X number of dollars worth of sheds and they depreciate at this rate. So your accountant is then given a year-by-year amount that you can depreciate off that farm.
All right. So how come we're not already doing this? Like, is it something totally new or a new ruling, or how come we're not already doing this as part of our tax year? I think even with I've been involved in depreciation reports for about 20 years. So we start off doing residential and a few commercial reports. So like anyone that buys, say, a little investment unit that they're going to rent out, then we can go in and say, all right, the tax department will allow you to say write off the shower curtain or write off the carpet or write off the blinds. So that's been going, as I say, we've been doing it for about 20 years. It wasn't till about 10 years ago, my background's agriculture, and I thought, why does it not apply to farming enterprises? So we worked a few examples back and forth with the tax department we sort of established the criteria, how it applies to farms. In principle, it's exactly the same. Right? You buy assets to make a living out of, then those assets deteriorate over time, so therefore they depreciate. And the tax department has a rate of depreciation that they will allow. All right. So it's a bit hard to ask you, but can you give me some sort of an example, a dollar figure example, on how much benefit you might be able to get out of having a schedule done up on your recently purchased property?
Yep, for sure.
Interestingly, I used to say to people that a boundary fence will more than cover the cost of any report, until I started doing some irrigation farms, and I was being looked at funny, and they were saying, well, hang on, we don't have boundary fences. So I had to change my catch cry a bit. But, okay, so let's take a typical mixed farm, because most people can understand that. So you've got, again, use $1 million, because it's easy for me to sort of remember. You've got a shearing shed, a hay shed, one or two machinery sheds, fencing, etc., a couple of silos. We would typically, out of that $1 million that you paid for that farm, to be able to claim somewhere between 20 and 25% of that. So in other words, 250 grand worth of deductions. Now, as I say, those deductions are spread over, depending on the mixture of assets, how quickly they depreciate. But most of it will come in the first, say, 12 to 15 years, and then it sort of tails off for the next sort of 15, 20 years.
Righto. So, that's 200 grand over that period that you can deduct from your tax liability, I suppose. Over that period of time.
Yeah, accountants treat it in two ways, or exactly the same way. But so that whatever figure, say we had that farm that we just talked about, then we might expect the first year you might get 25 to 30 grand that we can write off in the first year. It's not uncommon. Now that 30 grand will go into the profit and loss statement. Basically becomes, like other depreciation, a non-cash cost. Right? So it'll lower our taxable income, but it's not an actual cost that we're spending. Some accountants will put it separately, as in property depreciation. Some accountants just put it in with the other depreciation. In the end, it doesn't matter. Yeah.
Righto. So this is what the service you're providing isn't something that your accountant can just do themselves, is it? It's something they've got to have a third-party report on?
Yeah, no, that's right. Basically, they need an independent report, and going back to I was talking about quantity surveyors. That's why we use a quantity surveyor, because they're considered by the tax department as the experts for putting the values on those assets, right? The old shearing shed, the hay shed, the house, whatever's on the farm, the quantity surveyors. So basically, tax department will accept quantity surveyors, and you go back to residential properties. If, say, someone's continually building speculation homes and units, right, so he's a developer, then quite often they'll accept those because they consider that they're, in the game day in, day out, and they're experts as well.
Yeah, okay. So how far, there's been a fair bit of property traded in the last few years. How far back, there's not too many new shearing sheds and those sorts of things. Like, how far back can you go in valuing these things? Does it matter? Some of these places have got shearing sheds on that are 100 years old now. Can they be picked up, or what's the restrictions?
Yeah, no, it's interesting. The age of the farm buildings, if you like, and farm, because in tax law it goes down as plant and equipment, so it doesn't have an age barrier. There is a distinction with dwellings or houses, right? So that won't complicate it, but you'll have a 50-year-old hay shed, like you say, or a shearing shed. It still has a value. The tax department will say, all right, we understand when you bought that property, you bought some assets as well as the land, and will accept the value that's put on those through a depreciation report, what those assets are worth as a part of that purchase price.
Righto. All right. So is this something that people should just ring you about and get a report and then hand it to their accountant, or is this something they should talk to their accountant first about, perhaps getting a schedule put together? How do you suggest people go about it?
Yeah, I guess probably both. Because I'm happy to talk to people and explain the process, because, as I say, quite often some accountants haven't sort of come across it before. Certainly more and more are. And as I say, I've been doing farm reports for about 10 years, and the number that are aware of them now compared to 10 years ago is, multiplied many times. But even when I'm talking to someone that's new, I will say, who's your accountant? Have a talk to them about the report, because there's no good us doing the report if he's handling their books some other way that I'm not aware of, or it's in, a trust or a company that's not appropriate. So we need to have the accountant involved as well. But it also, I can help people who are interested ask the right questions. And quite often, I don't take the accountant's place. And when we complete the report, it goes back to the accountant, and he uses it for the books. But I can help people ask the right questions to get clarity on what they need to do.
Righto. So, some practical questions then, Tony. How much infrastructure do we need to make it worthwhile getting a depreciation report done, or if we've just bought a property?
Yep. So very, very little, really. We go back to what we were saying before, basically a boundary, as I was saying, a boundary fence. So that'll give you an idea, even if a property hasn't got a boundary fence. The boundary fence will more than pay for the cost of a report. And anything inside that then obviously is a bonus and sort of helps lower your taxable income.
Just make that clear though, what you can get out of depreciating the value of that boundary fence will effectively pay for the cost of the report, is what you're saying. Yeah. That's very good. Very good. So, how long ago will somebody have had to have purchased more property for this to apply? How far back can we look?
Yeah, a little bit. It's sort of each individual, obviously, because depending on the size of the property and how much was on it. But I haven't found any farms really that I've, say, purchased even 8 or 10 years ago. We go back to about 8 years. Like in reality, I can go back as far as you like, as long as you tell me what was on that property because the reports are based on the date of settlement, right? So let's say you've settled, we'll even make it now, say 2010, so 8 years ago. I would need to know what was there and if you've, say, built more sheds, then I'd need to know that, because that wasn't part of the purchase arrangement, if you know what I mean. But those sheds would still, as I say, because the report goes over, say, 30 odd years, those sheds, while some of it would have depreciated, and the issue becomes, I guess, is because the accountant can only go back so far without applying to the tax department for an exemption, right? So I can go back 10 years. Your accountant might only be able to go back, 2, 3 or 4 years, unless he sees the value in contacting the tax department saying, can we have an exemption to go back further? That's my understanding of how most accountants deal with it. Yep.
So what about in the case of a sale, like an interfamily sale or an inheritance or any of those sort of, in-house transactions that quite often happen as well? Can we pick those sort of changing titles up?
Yeah, we can. I guess we've got to make sure, and again, this is where the accountant is important to be involved in the process, that it's what they call an at arm's length arrangement, right? So it's at commercial value, and I guess in reality, most where the accountant, your accountant, and who you're inheriting or being gifted the property from is different. Right? Because otherwise they could say, well, you just pick up the whatever just depreciated from the previous owner.
Yep. Righto. All right. So it's a little bit more complicated, but it's a matter of talk to your accountant before you do anything.
Exactly. And as I say, everyone's different. So I'm trying to keep it fairly basic, but at the same time, give enough information. But it is quite complicated, and each one sort of individually different.
Yeah. Yeah. And I suppose the other thing is people, we get a bit complacent with what's on property at the moment. I think, we've got nothing to depreciate. But when you start looking around and saying, well, boundary fence is a classic one, sheep yards, cattle yards, fences,
Yep.
tanks, troughs, bores, silos.
Yep.
There's plenty of equipment there that are structures or are fixtures to farms that you can pick up in your reports too, isn't there?
Well, that's right. But I've also done plenty of properties, so that have been bought as an add-on block that basically only have fencing and maybe some water structures. Now, see, fencing alone, and this is not a guarantee, but in my experience, fencing alone, go back to that farm that I was talking about, $1 million, the fencing on that would be worth about between 7 and 10% of your purchase price. So in other words, 70 odd grand, maybe a bit more in fences alone. So that's what I mean. Like, it more than cover themselves.
Yeah, and I suppose the other one, I'm just thinking out aloud, the other one that people probably take for granted is dams or ground tanks too. Like that's a structure, isn't it?
Yes. Yeah, we include them in the report. Again, it's a discussion with the accountant about how they deal with them. But they're, like, from our perspective, they're an asset on the property that you purchased. Right? It's a bit like another interesting one is a house that you live in. So you buy a farm and you're living in the house. So in reality, I guess that's a private use or a private residence. Yep. We include it in the report because it's part of what you bought. Right, and then in discussion with your accountant, we can either take that out of the report or he can take it out of the report. But it was there to start with, so we've got to include it in the report, and then, because then it happens quite often. People will live there, and then they'll find a better house or a bigger house or something, or move to another block, and then you can just pick up the report from where you moved. And then add it in if you're renting that property out.
Yeah. So, Tony, these reports, are they a one-off or something that has to be done every year?
Yep. No, they're a one-off. So basically we go back and we basically take a snapshot of what was there at settlement, right, and say, all right, there was, as I say, 1 shearing shed, 2 machinery sheds, blah, 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 blah. And then run them through. The only reason we would come back and occasionally have it, if you've done some major infrastructure, like after you've bought the property, so you've knocked down the shearing shed and built a new shearing shed, new yards, sometimes the accountant will say it's better for us to go in and redo a report. Because obviously if you do those things after you purchase, you'll have the invoices. So you can give them straight to the accountant. But sometimes it's easier and cheaper for you in the long run to get us in to do the report so that then it's all tidied up in a booklet where he just reads off each year how much they can add to the depreciation.
Yeah, righto. So separating and generating this depreciation forward, is that going to affect anything in the future, like your capital gains or something like that?
Yeah. So what we're doing, it does lower the cost base over time. 2 things. If it was a property that you were going to buy and then sell within the next couple of years, then you might say, well, it's hardly worth doing. Basically, agriculture is a buy and hold proposition, so that's not an issue. And every accountant that I talk to say that if we can convert some possible future capital gain implication, because there's so many things they can do with capital gain, like if you roll it into another active asset, they can do certain things with it. If we can convert some possible future capital gain into income tax savings now, then do it every time. That's the feedback I'm getting from accountants all the time.
Yep. Yeah. And look, I think that's important and you've made the point several times here. You're not replacing accountants or anything like that. It's just an extra tool, and working with people as existing accountants and existing financial structures, but a good opportunity to just, reduce some of that tax liability as well, especially while, we've been picking up, a lot of producers have bought country in the last few years, and a good opportunity to just reduce that tax liability going forward.
Yeah, and I see, as I say, my background agriculture, and most of the tax savings in these reports, as I say, are up they start off higher and they gradually sort of become lower as we go on. And when you buy a property, the first couple of years is when you want as much positive cash flow as you can. And once you get into your stride after 2 or 3 years, you seem to be, it's more within. So this has helped two ways. It lowers the tax, and it lowers the tax or increases your disposable income, if you like, in those first couple of years when you need it.
Yep.
Going back, going reason for keeping the accountant in the loop is that the tax laws are changing from time to time. So back in May 2015, one of the changes that come in was saying basically fencing that you purchase, so fencing on these properties, or new fencing that you put in can be written off in that first year. A lot of people are aware of that. So that can be a huge benefit in your first year of owning a new property. And not that it's going to affect you. The thing is, if you ever sell that property, then the next person can't write the fencing off because you've been able to accelerate the depreciation. That also applies to silos that you use for fodder conservation. Right? So if you had some big silos that you stored sale grain in, it doesn't apply, but it does to fodder silos for drought proofing.
Yeah, okay. Righto. So, no, that's important. And as you said, the rules change a bit from time to time. So, things can be adjusted, and your accountant will help adjust those on a year-to-year basis as the rules change. Yeah. So, Tony, now, I suppose, where do you go? What sort of an area do you cover?
Basically, have a car, will travel.
Have a car, will travel. So you're not restricted to Riverina or New South Wales or anywhere else like that? No. Go wherever people's assets are?
Yeah. So basically what we do is we end up, if we get a farm in an area, then we'll tend to put 3 or 4 or half a dozen farms together to make a week out of it and then go and do them in that area. So we've completed reports, for example, in Victoria, New South Wales, Queensland, and Western Australia. So South Australia and Western Australia. So, and again, it's just a matter of coordinating how and where we do those.
And how long does it take to do the average size farm? How long would you allocate to do the report?
On farm, it'll vary. Probably how good the scones are, really. You might get me out of the house. No, it'll vary from an hour and a half to half a day, a bit more, and then obviously you've got travel time, and then you've got we'll probably spend more time in the office, doing the report up after we do the farm inspection. The other thing we notice is that the first farm we do for someone, because quite often once someone's had one of those reports done, the next time they buy a property, or the first thing they do is come to us and say, do a report on this, and then it becomes a fair bit quicker because everyone knows the process.
Yeah. Righto. And a lot of that background information you'd already have too, which would help as well.
Yeah, and just like making sure that we've got paddock maps so that we can identify where all the fencing is and where all the infrastructures are, in case there's a set of yards way out the back or silos out the back or water troughs, dams. Yeah.
Yeah. All right, very good. And look, I suppose that's the thing, the whole process, like getting these reports done, it's not a big drama. like it's only a couple of hours out of your, and it's a one-off thing for your property. So
yes,
and the benefits will last for years to come on your depreciation scheduling.
Oh,
going forward.
Exactly. Yep. So
all right, sounds like a good idea. Nobody, go on.
Yeah, I was going to say, so we basically take, we'll take a couple of hours to half a day, and like you say, the benefits will roll on for the next 20 or 30 years.
Yeah. I know. Sounds very, very good. And Tony, you've got some connections back in our tramping ground, the Riverina. You've spent a number of years in the Riverina. Is that right?
Yeah. No, I mean, most of my life. So I grew up at Coolac near Gundagai, in and around Gundagai, and then I went through Wagga College at the time. What did I do then? Moved back to Gundagai for a couple of years, school teaching, and then I went up to Canamble with the with the Department of Ag as a sheepo, and then back to West Wyalong. And then the early 90s, I started as a rural financial counsellor for about 15, 17 years in around the Riverina.
Yeah, right. Yep. So you know the area very well then.
Yes. Yeah. There's not too many roads that I haven't been along, or not a lot of farms that I haven't been on either, really, I suppose, over the time.
Yep. It's probably, and it's probably a lot of your clients, you know them already anyway, or you've met them through one form or the other.
Certainly in that Riverina, and as I say, one of the interesting things to me is how far clientele of a particular accounting firm might be.
Of course.
So they spread out. So once we get known and they know we're doing a good job, then they might say, well, I've got a client up here at, Wanaring or wherever. Yeah, can you do it? Or Dubbo, or, it doesn't matter, or down in Victoria. So we tend to sort of, as you say, the Riverina is the heartland of where our business is, I guess, but we certainly branch out and more as the network grows, I guess.
Very good. All right, Tony. So what's just your company again? Property Ally. What's the best way people can get in contact? Yep. What's the best way people can get in contact with you?
Telephone, which mobile 0427 710 462, or probably email, which is just simply TJ Paton, so TJPATON @bigpond.com. So if people want to do that, then I can send them out a sample report and a flyer and like a standard letter that we sort of give to people to sort of explain the process. And, that works pretty well.
Very good, very good. Right, well, thank you very much for your time today, Tony. It's certainly a very important part of running a modern business, and as you said, nobody likes paying more tax than they need to. So, well worth having a report done and getting that deduction where it's possible. So, again, look, thank you very much for your time, Tony, and hopefully people will give you a call and with plenty more questions.
Yeah, well, thanks, Jason, and you're right. Like, people contact us. It's obviously no obligation. And it might be, for some, as I say, for one reason or another, they might say, we won't, it's not appropriate or not appropriate at this time. We'd go through all that. We won't do a report unless it's going to be to their benefit. So we'll go from there. That's how we, as I say, that's how we build our network, by sort of knowing that we'll get the job done.
Very good. Very good. Righto, Tony, we'll catch you next time, and thank you very much for your time.
Thanks, Jason. Talk to you soon.
Thank you.
Bye.
Cheers. Bye.